How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Sorry, this episode's coming out a little bit late here, a couple days late. I was actually on vacation this week, and I came back kind of late this weekend. I thought I could get this episode out on time, but just wasn't quite right. So I didn't want to put out something that was really sloppy and messy. So I figured I'd just give it an extra day and finish putting the touches on this thing before I rolled it out. So with that being said, so this is the weekly banking update where you guys give me 30 minutes and I try to give you the rundown of everything that's happening here. So I try to give everybody a little bit of economic indicator news for what happened the week before, what's coming up this week. I try to give everybody some of the basic banking headlines and a little bit in-depth analysis on a few things here and there. I will share a few articles at the end of this video, so definitely stick around for that. And then as far as other episodes coming this week, so I'm hoping to put out an episode every day this week. So basically Tuesday, Wednesday, Thursday, Friday. And then this weekend, I'll have a kind of a new slate of videos. So this week will kind of be getting out the videos that I had meant to come out for last weekend. And then I'll have the newer episodes coming out this weekend. So off just a little bit this week, but hoping to get back. But hopefully everyone sees my wonderful tan or whatever. So I'm a Pennsylvania boy, but I vacation a lot in North Carolina, and that has North Carolina has absolutely become my adopted state. Love North Carolina. If there's any listeners out there that are in the North Carolina area, love the state, man. Love the state. Love being down there. Love the beaches. Love the mountains. Places like Asheville, just fantastic. Raleigh's wonderful, Charlotte's wonderful, Wilmington's wonderful, Jacksonville's wonderful. Just so many great spots in North Carolina. So that's my little North Carolina speech. But okay, so let's kick in. So what are some of the things that were supposed to be coming out this week? So on Monday we had consumer inflation. On Tuesday, July 9th, Fed Chairman Powell sat down and basically talked, and he testified in front of Congress. We got the 3-year Treasury auction notes. FOMC member Bowman speaks. On Wednesday, we get crude oil inventories. We get the 10-year Treasury note auction. On Thursday, we get CPI month over month. We get the initial jobless claims. We get 30-year Treasury bond auction. We get the federal budget balance. And on Friday, July 12th, we will get the PPI. We will get the Michigan consumer sentiment, and we will get the U.S. Baker Hughes oil rig count. So we're getting some little bit of job data, definitely some good inflation data with the CPI and the PPI. We're getting some Treasury auction numbers, and we're getting some testimony from Fed Chairman Powell and one of the other Fed FOMC members, Mickey Bowman. So good stuff coming up this week. And now let's hit some of the highlights. So some of the news coming in here. So senior U.S. law enforcement officials said drug traffickers laundered money through Citigroup Inc. due to its less robust fraud controls, the Financial Times reported. In an indictment unsealed last week, supported by statements of Drug Enforcement Administrative officials, U.S. prosecutors detailed how the bank's ATMs were used by the criminals to launder almost $36,000 in illicit cash on at least 3 separate occasions in January of 2021. Citi declined to comment, citing secrecy requirements around transaction reporting, the FT noted. Also mentioned was an alleged deposit of a cashier's check at a JP Morgan Chase & Company ATM and about $100,000 of United States currency at a Chase Bank teller window in 2023 ATM made by another drug trafficker, the report said. Top U.S. banks, including JP Morgan Chase, Citibank, Wells Fargo, Morgan Sachs, Bank of America, and Morgan Stanley, announced plans to raise their third quarter dividends and other capital actions after markets closed on June 28th. The announcements followed the June 26th release of the annual Federal Reserve stress test results, which surprised analysts was higher than expected hypothetical losses. I will cover that at the end. I've got an article relating to that at the end. So if you want to know a little bit more about information on the stress test, just hang out for a few more minutes. 4 banking trade groups, the Bank Policy Institute, the American Bankers Association, the Institute of International Bankers, and the Securities Industry and Financial Markets Association, wrote Jen Easterly, the director of the Cybersecurity and Infrastructure Security Agency, a shared letter expressing concerns over increased regulatory burden and elevated compliance costs for banks due to the role proposed to implement the Cyber Incident Reporting for Critical Infrastructure Act of 2022. That's a mouthful. Yes, obviously, I would think it would be fair to say the sentiment right now is that banks are not happy in general with the regulatory environment and what they perceive to be a very burdensome regulatory environment brought on by Democrats, which is really no surprise there, since they are all about regulation and then some. So, okay, junior bankers are facing a growing prevalence of 100-hour work weeks at Wall Street investment banks as companies chase a modest yet growing flow of deals. Bloomberg News reported, citing unnamed sources from big banks. So facing growing prevalence of 100-hour work weeks. That's interesting. So something to note. The financial industry regulatory authorities' enforcement actions declined to the lowest level in its history in 2023, even as the agency's headcount and budget expanded, Bloomberg News reported. Further, total fines in 2023 are down by about half since a peak in 2016, the report said. FINRA does not agree that it pulled back on enforcement, according to the report. The U.S. Treasury Department adopted a final rule requiring brokers to report gross proceeds on the sale of digital assets to the Internal Revenue Service starting from 2026 for all sales in 2025. Further, brokers will need to report information on the tax basis for certain digital assets beginning in 2027 for sales in 2026. So that's something to keep an eye on. The Treasury Department's Financial Crimes Enforcement Network, FinCEN, issued a proposed rule to amend financial institutions' anti-money laundering and countering the financing of terrorism, AML, CFT programs, explicitly requiring companies to ensure that these programs are effective, risk-based, and reasonably designed, and include a mandatory risk assessment process. So FinCEN looking after AML, and I'm sure there's BSA stuff in there. It's not far behind. Okay, this is a good one. The U.S. Supreme Court overturned a 40-year legal precedent known as Chevron deference, effectively reducing the rulemaking powers of a wide range of federal agencies, including bank regulators, as federal judges will no longer defer to regulatory agencies' interpretation of laws, the Wall Street Journal reported. Now, this is a huge case. And I don't even think huge is a good adjective to describe this. I mean, this is monumental, historic, earth-shattering. I mean, I think those would be better ways of describing how big this is. And there will be another episode coming out this week. I'm going to talk about this and basically try to get into the nuts and bolts of what this is, why it matters. Is it really going to have as big of an impact for banks, at least maybe initially, or will it take a little time? But like I said, a lot more information to come on that. The U.S. SEC, the Federal Reserve Board, and the California Department of Financial Protection and Innovation, which is called the DFPI, separately imposed penalties on La Jolla, California-based Silvergate Capital Corp and its subsidiary, Silvergate Bank, our old friends at Silvergate Bank, and certain executives for misleading investors and compliance failures. The companies and executives allegedly misled investors about the strength of their bank secrecy and anti-money laundering compliance programs, and Silvergate Bank's failed monitoring of cryptocurrency customers, including bankrupt cryptocurrency exchange FTX Trading from November 2022 to January of 2023. The combined penalty includes a $20 million fine to be paid to the DFPI, a $43 million fine to the Fed, and penalties worth $50 million imposed by the SEC, which will be offset by Silvergate's payments to the DFPI and the Fed. Now, I will have to do a little research on this because my understanding was that Silvergate Bank had failed and was no longer operating, but maybe that's not the case. Now, Silvergate Capital Corp is basically a hedge fund that owns and operates Silvergate Bank. Now, for people who don't know, if you want a lot more information on Silvergate Bank, go back to my crypto series. Go back to the crypto series. Go back to the parts 3 and 4, where I talked about the crypto crash of 2022, which in my hypothesis led directly to the financial crisis and the failure of these three banks in the spring of 2023. I am even perhaps working on a book on this whole thing because I find it that interesting. But Silvergate, the important thing to understand about Silvergate is that they operated what was called the SEN network, SEN, Silvergate Exchange Network, SEN. And that was the major rail line for cryptocurrency exchanges to get money into the banking system, a la Signature Bank and Silicon Valley Bank. And that's the important thing you have to understand. That's the thing that ties the whole thing together. And you can literally follow the dates. March 3rd, Silvergate Bank shuts down the SEN network. March 5th, Silvergate Bank fails. March 8th, Signature Bank fails. March 10th, Silicon Valley Bank fails. Literally within 7 days, all of it done. And that's how it all went. Boom, 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 boom. Just like a bunch of dominoes going right on down. So anyway, okay. So so moving on to some other stuff here. So some bonds tied to the bankrupt SVB Financial Group became one of the biggest gainers in high-yield debt trading on July 1st, after the Internal Revenue Service agreed to reduce one of the company's tax claims from about $649 million to $43 million. Very nice of them. Bloomberg News reported, citing court papers and Trace, the reduction was related to the dispute over SVB's financials using a market-to-market accounting method to value certain financial products, according to the report. U.S. bankers are concerned over corporate borrowing activity, which rose sharply in the first half of 2024, slumping in the future quarters due to the uncertainty around presidential elections and timing of Fed rate cuts, the Financial Times reported, citing several bank executives. Bankers attributed the pickup in activity partly to companies pulling forward their financings to avoid potential volatility later in the year, the report said. Lawmakers led by Senator Sherrod Brown, chairman of the Senate Committee on Banking, Housing, and Urban Affairs, in a letter urged major investors, the principal bank and fintech partners of the bankrupt Synapse Financial Technologies, Inc., to restore affected customers' access to their deposits currently frozen by the bankruptcy. If you would like to learn more about this, go back about a week or two to my episode that I did on the Synapse bankruptcy. I'm sure there will be more updates soon, but it's nice that he wrote a letter asking them to basically restore customers' access. The problem is they can't find like $85 million. It's gone. They can't find it. And Synapse is literally done. They laid off all of their employees. And thus, this is the big problem. So they shut everything down, laid off all their employees. I guess in a sense, handed the keys to their systems to the banks they were partnering with so that the banks could have access to it. But I don't really understand how that works. But the bottom line is you can't give access to money that's not there. So it's a crazy thing there. Okay, Robinhood Markets agreed to acquire artificial intelligence-powered investment research platform Pluto Capital. The company announced in a July 1st release, Pluto founder and CEO Jacob Sansbury has joined the Robinhood team to accelerate its product roadmap and help integrate AI-powered capabilities across the Robinhood platform, the release said. And additionally, digital trading platform Robinhood plans to offer cryptocurrency futures in the U.S. and Europe in the coming months, Bloomberg News reported, citing people familiar with the plan. The commission-free investing platform hopes to use Bitstamp Limited's licenses once it closes its $200 million acquisition of the London-based cryptocurrency exchange, according to the report. I don't like Robinhood. I feel like the Robinhood has done a lot of shady things in its past. I don't like the fact that it sells, it offers free trading and it sells all of your data to Citadel to do that. There's just, and now it's like, oh, they're getting into AI, they're getting into cryptocurrency, they're getting into all these other areas. I don't know. Maybe I'm wrong. Maybe this could work out. Maybe Robinhood will just continue to grow and expand and be this wildly successful company. But I am skeptical. Okay, BlackRock aims to drive growth in the private markets, focusing on data analytics and index business with its acquisition of Preqin, according to CEO Larry Fink, who said on July 1st deal call that by leveraging our investment capabilities, Aladdin, eFront, and eventually Preqin data, we believe we could index to private markets. Finks added that the company could bring the principles of indexing even iShares to the private markets. Meanwhile, Preqin CEO Mark O'Hare, who owns 80% of the company via his holding company, Valhalla Ventures will net roughly $2 billion after taxes in the all-cash deal with BlackRock, making him richer than Larry Fink, who has a $1.7 billion net worth, Bloomberg News reported, citing data from Bloomberg Billionaires Index. Isn't that wonderful for them? The Commodity Futures Trading Commission issued a report detailing the results of its fourth quarter supervisory stress test of Derivatives Clearing Organization, or otherwise known as DCO, resources based upon its study of 9 individual DCOs comprising 11 clearing services. The report concluded that the DCOs hold sufficient financial resources to withstand many extreme and often implausible price shocks. So again, that's the Derivatives Clearing Organization. More BlackRock news. Asset managing giant BlackRock has a new policy that aims to strike a balance between the demands of U.S. and European clients on decarbonization on one hand, and U.S. laws requiring fund managers to prioritize financial returns on the other, the Financial Times reported. Citing a letter to clients from BlackRock's global head of stewardship, starting in the fourth quarter, clients in BlackRock's climate-focused funds, all based in Europe, can take an activist position on shareholder proposals about decarbonization, while those in all other funds will continue to undertake BlackRock's stewardship role, with a sole focus on advancing clients' long-term benchmark policies, aligned financial returns, according to the report. That's called BlackRock trying to make everybody happy. They're trying to make people in Europe happy with that just absolutely are on the ESG train, and the people in the US who basically have had enough of ESG and have basically shot that thing down. So I don't know how I don't know how that balancing act is going to play out in the end. We'll find out. But I would not be shocked if that gets messy. Goldman Sachs Group will have a hard time convincing the Federal Reserve to reconsider its failing grade in this year's bank stress test, the Financial Times reported, citing regulatory experts. Goldman's Fed test results are likely to entail about $6 billion in additional capital that the central bank would require the bank to hold to cover potential losses, and such higher capital could curtail Goldman's capacity to lend and trade, as well as limit profits, investors' share repurchases, and dividend payments, the report said. Federal Reserve officials said they would not lower the federal funds rate until more information comes out and gives them more confidence that inflation is moving sustainably toward their 2% target, according to minutes of the Federal Reserve Open Market Committee's recent meeting. The Fed officials noted that the reduction in inflation had been slower this year than they had expected last December. And then finally, banks might have to disclose their exposure to cryptocurrency assets from January 2026, a year earlier than originally indicated, Reuters reported, citing a statement from the Basel Committee on Banking Supervision. Global banking regulators have approved the templates for the information, according to the report. These disclosures aim to enhance information availability and support market discipline, the report said. Okay, what else happened? First quarter GDP got revised. The gross domestic product increased at an annual rate of 1.4% in the first quarter, up from 1.3% previous estimate, according to the Commerce Department's third estimate. In the fourth quarter of 2023, real GDP increased 3.4%. Yeah, a 1.4% growth rate is not a good growth rate. Factory orders rise in May. So new orders for manufactured goods increased 0.1% in May, the fourth consecutive monthly gain. Again, 0.1%, not blowing the doors off of anything. Private sector added 150,000 jobs in June. Private sector employment increased by 150,000 jobs in June, but I believe the headline number was actually higher than that. I believe it was 208,000, which came in last Friday. But I think when you dug deeper down into that report, you saw that all the growth was basically, again, it's part-time jobs. All the jobs are going to foreign-born workers. That way, a fancy way of saying illegal immigrants, and not going to foreign-born workers. So not going to U.S. citizens, which is a major problem. And then you also see that if you dug deeper in the numbers, that the jobs are all going to government. It's government and healthcare, which is being funded by the government, and everything else just rolling. So service sector index contracts in June. So economic activity in the services sector decreased in June after growing in May. Let's see here. Factory orders. It's interesting. One said it increased in May, and another said it declined in May. So that's interesting. Manufacturing dips in June. Economic activity in the manufacturing sector contracted in June for the third consecutive month. Construction spending dropped in May, so construction spending fell 0.1% in May, but was up 6.4% from a year ago. Personal income spending increased in May, so personal income increased 0.5% in May, and consumer spending increased 0.2%. The PCE price index, a key inflation gauge, decreased less than 0.1% in May and is up 2.6% from a year ago, down from 2.7% in April. The PCE is the Fed's favored inflation index. Consumer sentiment drops slightly in June. Consumer sentiment dropped 0.9% in the past month, but was up 6.2% for the past year. The Basel Committee moves forward on crypto standards. The Basel Committee on Banking Supervision announced that it has reviewed the comments on its proposed crypto asset exposure disclosure and amendments to its standard on banks' exposure to crypto assets. Going to keep an eye on that one. FinCEN underestimates suspicious activity reporting burden. So the Financial Crimes Enforcement Network underestimates the amount of time and resources community banks dedicate to reporting suspicious activities. Yeah, I would probably say that's so. The FHFA data, median mortgage payment, the median mortgage payment in the U.S. is now $1,520. According to the FHFA information on outstanding residential mortgage debt at the end of the first quarter, there were 50.8 million outstanding mortgages with unpaid balances totaling 11.7 trillion with a T. 9% of outstanding mortgages have interest rates below 3%, down from a high of 24.6% in the first quarter of 2022. 3% of outstanding mortgages have interest rates of 6% or higher. Adjustable rate mortgages account for 3.5% of outstanding mortgages, down from 9.6% a decade ago. And the average credit score among borrowers with an active loan is 743. Not bad. Okay. Let's bring in a couple articles here real quick. So let's see here. Again, kind of what we talked about a little earlier. Preferred inflation gauge inches toward goal, raising odds of a fall rate cut. So Federal Reserve's chief measure of inflation growth fell to its lowest point since March of 2021, within striking distance of the central bank's target. Yet a long-awaited rate cut remains highly unlikely before September. The core personal consumption expenditures, or the PCE price index, which excludes volatile food and energy prices, you know, the most important thing, the stuff that you actually buy every day, rose 2.6% from May 2023 to May 2024. The Bureau of Economic Analysis reported on June 28th, and then we can see a nice little chart here, personal consumption expenditures, and then personal consumption expenditures excluding food and energy, which is the green. And yeah, so we have this. So obviously the Fed is holding off right now, and we're going to see what happens here with this. Again, I've stated my thought is, nothing's going to happen over the summer. I've said that before. I mean, nothing's happening in July and August. If a rate cut does happen, it'll happen in September, and if not September, probably October. All right, let's see here. Moving on, banks keep powder dry, selectively prune their bond portfolios. So banks engaged in fewer restructuring trades and put less cash to work in the bond market in the first quarter as rates remained higher for longer and institutions remained focused on maintaining liquidity. Fewer banks engaged in loss trades to reposition their underwater bond portfolios in the fourth quarter as intermediate rates increased in the period. Further increases in intermediate rates in the second quarter likely limited additional repositioning activity, particularly as bank managers eye the seasoning of their portfolios and the prospect of lower rates on the horizon. Incremental pruning and repositioning of bond portfolios should continue, with banks selling portions of their portfolios and using proceeds to reinvest in higher yielding securities. Institutions appear to be approaching restructuring and new investment activity with some trepidation as they remain focused on maintaining strong capital and liquidity. And here again, a chart here. We're looking at a chart on net unrealized gains and losses and implied unrealized gains and losses. And you can see that for basically the last 2 years, soon to be going on 2.5 years. This chart is ugly, and it's continuing to be ugly, and it's not getting a whole lot better. And as the rates stay higher, and part of the problem is, a lot of the banks are in a position now where they can't sell these securities, because if they dump the securities, it's going to hurt their capital. It's going to bring their capital levels down below where the regulators want them, which will then require them to have to go out and raise capital. And is it a great environment for raising capital? No, because bank stocks are down. And then you always run into the old issue of, do you want to dilute your shareholders by raising additional capital? Now, there's a number of different methods for raising capital. You could do subordinated debt. You could do a good old-fashioned capital raise. You could issue stock. I mean, there's a number of different things that you can do there in that realm. But the point being is that there are no necessarily great attractive options at the moment. And I think the bigger issue is, rates are, even if rates come down, it's not going to automatically fix this. Because the federal, in other words, if the Fed brought rates down by 300, 400 basis points, this would probably get fixed pretty, within a few quarters. They're not going to do that. I mean, they're probably going to drop 75, maybe 100 basis points. I mean, it'll help, but it's not going to make this go away. I mean, sooner or later, banks are going to have to bite the bullet on this and basically sell out and reposition, what they've got. And basically you got to hope that nothing happens in this interim period. So, okay. Moving on here. So U.S. banks net interest margin trough on the horizon, but return to growth is still far away. So U.S. banks should soon feel some net interest margin relief, but growth is still a ways out. In the first quarter, 251 U.S. banks had net interest margins at or below 2%, comprising 5.2% of the industry, the highest percentage since the COVID-19 crisis, when stimulus weighed on banks' margins, and higher than the peak percentage in 2009. The number of banks with net interest margins lower than 2% increased by 176 banks between the third quarter of 2022 and the first quarter of 2024, marking the fastest increase since the financial crisis of 2007. And then we can see here from the chart here, PPP loans depressed net interest margin in this section of the chart here, and then we can see it coming back down. You see it getting relief, and then you can see that compression coming back up. That's a good number of banks right now that are below 2%. I mean, 251 banks is that's a good number there. Not a good number is like that's good. It's a good number is in that's a large number of banks that are sitting in this position right now. So, to bolster their performance, several banks have restructured their underwater securities portfolios and set pricing floors on new loans. U.S. banks realized losses on available for sale securities peaked in the third and fourth quarters. We've already covered some of that. But obviously that margin compression, big thing, so, big thing, and it's not doing any favors right now. And then let's get to these last two articles real quick here for our wrap up. So U.S. banks projected stress test capital requirements, loss rates surprised the street. So quarters of capital building have left big banks with sufficient stockpiles to weather an economic storm, but the Federal Reserve stress test still came with surprises. All 31 banks in the Fed's stress test analysis had ample capital cushions to withstand a severe recession and stay above required minimums, but loan loss rates increased year over year, and several banks are projected to receive surprisingly high stress test buffer requirements despite a similar scenario from 2023's test. This year's results validate the group's safety and soundness, but higher SCBs make the exercise feel like a step back for the group overall. Under this year's stress scenario, the aggregate minimum common tier 1 ratio declined 2.8%, higher than the 2.3% in 2023 and the 2.7% in 2022. And it's the highest CET1 hit since 2018. We expect this sharp increase in capital requirements may delay or reduce long-term capital return plans. JP Morgan Securities analyst Vivek Janeja wrote in a note. And then we can see it that basically here. So this is a chart showing under severe adverse scenario, pre-provision net right here, provisions for loan and lease losses going up. Yeah, this is the increase here in basically credit losses, trading and counterparty losses, other gains. So, yeah, so some winners and losers in this, basically Citigroup, Huntington Valley, and M&T Bank Corp, and Goldman Sachs, and Key Corp, Citizens Financial Group, some of the ones that didn't do as hot. And then the last thing, Fed preferred, and I think I already hit that. Yeah. Fed preferred, Fed preferred inflation gain inches toward goal, raising odds of a rate cut. We already talked about that one. And then I think, the last one here was largest U.S. banks underperform in June. So the largest U.S. banks dragged on the country's banking market performance in June. And it gets into a little bit more about the stress test and then talks about their overall financial performance. But anyway, so let me wrap this thing up. So I hope you guys enjoyed another weekly banking update. I will try to get back to you guys with more information real soon. Please make sure to check out some of the other episodes of the channel. If you haven't checked out things like the crypto series or my series on the Lords of Easy Money, please do. Please make sure to check out a lot of the great interviews that I've done on the channel, as well as some of the other things I've done as far as I do a number of book reviews. And I also get into, some like movie and documentary reviews and things like that. I'll have more of that stuff coming in the months ahead. So stay tuned for all that. But as always, if you like this episode, please make sure to like, share, and subscribe. That really helps the channel. Anything you can do to help to push the channel, I always appreciate. Remember, we are on YouTube, Rumble, and all major podcast platforms. And please make sure to leave your comments down below. I always enjoy getting the comments from the viewers and getting back to everybody. And as always, thanks a lot and have a great week out there. And I will be back the rest of this week and this weekend with more new episodes. So thanks a lot. See you later.